One of these two investors retired with $2.3 million. The other one retired with $1.1 million. Same income, same starting age, same amount of money invested every single year for 30 years. The only difference? One bought real estate, the other bought stocks. Now here's the part that will mess with your head. When you find out which one won, and why they won, everything you think you know about investing is going to feel slightly wrong. Because the answer isn't about returns. It isn't about leverage. It isn't about the market. It's about something going on inside your brain, and most people never figure it out until it's too late. Here's something no one talks about at the start of this debate. When was the last time you heard someone brag at a dinner party about their index fund portfolio? Never, right? But people talk about their properties constantly. I bought this place for $200,000. Now it's worth $450,000. It becomes part of their identity, their story, their dinner table moment, and that feeling that's actually one of the most dangerous forces in personal finance. Behavioral economists call it the tangibility bias. It means our brains are hardwired to trust things we can physically touch, drive past, and point to. A house feels like wealth. A brokerage account with $300,000 in index funds. That just feels like a number on a screen. Here's the brutal truth about that bias. It has quietly pushed millions of people toward the investment that feels better, instead of the investment that performs better. And in many cases, those are not the same thing. But wait, before you assume this means stocks win, here's where it gets complicated. Let's look at the raw numbers, and I promise you, the first one is going to feel obvious. The second one is going to feel like a mistake, and the third one is going to make you question both. Stock number 1. Stocks dominate on paper. If you had invested $10,000 in the S&P 500 in 1990 and never touched it, no extra contributions, no clever timing, just left it alone, it would be worth over $180,000 today. You didn't call a single tenant. You didn't fix a single roof. You literally did nothing. Over the last century, the U.S. stock market has returned around 10% per year on average. Adjusted for inflation, that's roughly 7%. And that number holds up across recessions, crashes, wars, and pandemics. Okay, you're thinking, stocks win. Video over. Not so fast. Shock number 2. Real estate's real return will surprise you. The average annual return on home prices in the U.S. over the last 100 years, adjusted for inflation, is about 1 to 2%. That's it. Most people stare at that number and think it's a typo. It's not. And here's why property prices feel like they're always going up, because we remember the price we paid 20 years ago, and we see the price today. But we forget about inflation eating most of that gain in between. So stocks win, right? Case closed? Here's the flip nobody expects. Real estate doesn't play by the same rules as stocks, because almost nobody buys a house with 100% of their own money. That changes everything. Here's a question most people never ask themselves. If you had $60,000 to invest, would you rather put it all in stocks, or use it as a down payment on a $300,000 property? Let's do the math. You put $60,000 down. The bank covers the rest. The property goes up 5% in a year. That's $15,000 in value added. But you didn't invest $300,000. You invested $60,000. That means your actual return on your money was 25%. This is leverage. And it's the reason real estate has made more millionaires than almost any other asset class in history. You're not just growing your money, you're growing the bank's money too. Try doing that with an index fund. Now, you'd think this settles it. Real estate wins because of leverage. But here's what most people spreading real estate is amazing content conveniently forget to mention. Meet a hypothetical landlord. Let's call him Daniel. Daniel bought a rental property 10 years ago. He's proud of it. He tells everyone it's his best investment. And when you look at the property value, he's right, it's gone up significantly. But Daniel hasn't tracked what he's spent. In the last 10 years, Daniel has paid property taxes every single year. A new roof that was $14,000. A new HVAC system, $8,000. 2 months of vacancy where the rental income was zero. A property manager who takes 10% of every rent check. Insurance premiums, every single year. On average, owning a rental property costs between 1 and 2% of the property's value, every single year in maintenance alone before taxes and management fees. Researchers have a name for what Daniel is experiencing. It's called the hidden cost illusion, the tendency to focus on the big visible number, the property value, while mentally filtering out all the smaller numbers bleeding out the other side. Daniel feels rich because his asset went up. He hasn't done the math on whether he actually is rich compared to the alternative. And this is where most real estate comparisons are deeply unfair, because they compare ideal real estate returns against ideal stock returns, not what actually happens to real people making real decisions. This is where people quietly lose years of wealth, not through bad investments, but through incomplete math. Here's something most financial content skips right over, because it's boring. But it's one of the most important forces in your financial life. Liquidity. If the stock market dropped 30% tomorrow and you panicked, which, honestly, most retail investors do, you could sell everything by noon. The money would be in your account in 48 hours. That's actually dangerous, because the ability to act on fear is the enemy of long-term returns. Real estate. You can't sell it in a panic. It takes 30 to 60 days to close. There are agent fees, closing costs, and taxes that eat 6 to 10% of the sale price. By the time you could exit, the emotional panic has usually passed. So here's the counterintuitive truth. Real estate's biggest weakness, being illiquid and slow to sell, is also secretly its biggest protection. It locks you in. It forces patience. And patience is the actual engine of wealth building. Stocks give you freedom. Real estate gives you discipline. And depending on your psychology, one of those is far more valuable to you than the other. So which one actually makes more money? Both can. Neither always does. And here's what the data from actual wealthy people shows most of them didn't choose. They built both. Stocks for passive, compounding, liquid growth. Real estate for leverage, income, and forced discipline. They didn't ask which horse runs faster. They built the entire stable. But if you're starting out and you can only do one thing, here's the honest framework. Ask yourself 3 questions. 1. Can you qualify for a mortgage, manage a property, and absorb unexpected costs without financial stress? If yes, real estate gives you leverage that stocks can't match. 2. Will a 30% drop in your portfolio cause you to sell? If yes, real estate's forced illiquidity might actually protect your wealth better than stocks will. 3. Do you want your investment to be completely passive? If yes, a low-cost index fund that tracks the entire market is the most powerful wealth-building tool most people will ever have access to. There's no universal winner. But there is a universal mistake. Picking the right asset with the wrong mindset. Starting strong. Then selling the moment it gets uncomfortable. That single mistake destroys more wealth than bad investment choices ever will. Remember those two investors we started with? The one who retired with more money wasn't smarter, wasn't luckier, didn't find some secret strategy that nobody else knew. They just stayed in the game longer than the fear told them to. The stock market dropped. They didn't sell. The property sat vacant for 2 months. They didn't panic. Their friends told them they were doing it wrong. They didn't listen. That's it. That's the whole secret. The winner wasn't the person who picked the better investment. It was the person who stayed invested when staying felt hardest. Pick one. Start. Stay. That's how wealth is actually built.